Hey everyone, welcome back. Today we're unpacking the paradox gripping Wall Street right now. So on one hand, we got US stocks hovering near these record highs. And then on the other hand, bond markets are flashing signs of anxiety about this predicted slowdown that everybody's been warning of. Throw on top of that hot inflation, trillion-dollar bets on AI, Trump tariffs. Jackson Hole is coming up super quickly. This Friday is the date to watch. And then Fed rate cut expectations. Throw all that up in a bowl, mix it up, and you got a market walking on a tightrope or a confusion salad. So look at this. Overall, today was pretty peaceful. Not a lot of moves, so stocks finished mostly unchanged on the day, but still near their record levels. The S&P 500 is up nearly 10% this year, closing just below its all-time peak of $6,468.54. And Henry Allen, that man is a strategist over there at Deutsche Bank. He's calling this the market's paradox. So what he's looking at are equities at these record levels versus bond spreads at bond spreads are the tightest versus treasuries since 1998, and that's the year I was born. That mix usually screams optimism, but at the same time, bond markets are pricing in 100 basis points, or if we put this into English, 1% of Fed rate cuts within the next 12 months. And why does the Fed cut rates? It's not because everything in the economy is just super great. So that's warning of signs of a recession or a slowdown. Now, Allen argues markets aren't priced for perfection or anything, and they're not priced for balance. But if growth picks up in the second half of this year, stocks could rally further, and especially if tariffs don't worsen and inflation becomes more of an issue. So in that scenario, inflation is the main risk. But if rate cuts don't happen because growth is actually stronger than expected, stocks could still flourish. Looking back at the history, last August, we got a weak jobs report, and what that did is raise recession alarms, but following data provided otherwise. So even now, payrolls don't necessarily scream recession. Unemployment's been in this range. It's been holding steady between 4% and 4.2% for quite a while now. Growth trackers from the Fed Banks of Atlanta and New York see GDP at 2.5% and 2.1%, so both solidly positive. Now, looking at, and this is kind of where it gets tricky, last week's CPI hit a 6-month high. Then we got PPI data, which is wholesale inflation. That ran the hottest it's been since 2022. And then tariffs are only now showing up in the prices. Add in new tax and spend fiscal policy, and upward pressure is becoming clear. Core inflation has been stuck above the Fed's 2% target for 4 years now, even though inflation's been the fight. So markets know all of this, and the 1-year inflation swap is sitting at 3.3%. So while, yes, there's optimism out there, inflation is still the Achilles heel for the market, and if the Fed must pivot hawkish, stocks could stumble based on that. Now let's talk about the AI super cycle. So this is the other driver, artificial intelligence. And artificial intelligence, according to Morgan Stanley, who estimates AI could bring in $920 billion in net annual benefits to S&P 500 companies. Now let's put that into perspective. I'm not even on the right page. Total net income for the index is around $2 trillion. Think about that, $2 trillion. AI could lift non-financial profit margins above 22%. So stock market value could grow by 13 to 16 trillion. That's a 22 to 27% boost. And the way it would do this is through cost cutting. So think like automation, lowering their employee headcount, streamlining processes to become more efficient, more productive. Also revenue growth. Think about how employees are freed up for higher value tasks because they're not stuck doing those tedious, redundant tasks. So big tech is definitely leading the charge here. Between 2024 and 2026, we had Alphabet, Microsoft, Meta, Amazon. Just between those companies, they poured nearly $1 trillion into AI infrastructure. Spending in 2025 alone is expected to come in at $340 billion. Now, of course, there are risks like job displacement, capital intensity, and over-reliance on just a few mega cap companies like some of these large tech companies. Think like Nvidia, for example, that's holding up the stock market. But if productivity booms, historically create new industries, so I guess that kind of offsets some of the risks if you look at it that way. Meanwhile, the government is bailing out a company is how a lot of people are seeing. So the Trump administration is stepping in on semiconductors, considering a 10% stake in Intel as part of this rescue effort. It's showing how critical chip making has become to the US and the global race going on, both for AI ambitions and national security. So yeah, it's seen as a dramatic move. You got direct equity investment by the government into a struggling US giant to really save the day. Now here's another theme. A giant pile of money in the US money market funds is now around $7.2 trillion. And what this is seen as, at first glance, dry powder for stocks. It's money on the sidelines waiting to be deployed to earn a better rate of return. But Goldman Sachs notes households always hold around 15% of assets in cash, which right now we're right in line with history. And in past rate cutting cycles, money didn't necessarily rush out of these money market funds. It actually continued to grow because there's all of the uncertainty, all of the volatility. People are worried about catching a fallen knife and deploying their cash, and that cash becoming worth less because they made a bad decision with it. So what they're pretty much warning in this article is, hey, don't expect this cash to suddenly flood into equities and stocks just go to the moon tomorrow. Then, on top of that, there's still these two fears that they see for this market potential sell-off. So Tom over at Sevens Report says that the real risks to this bull market are just of two. So stagflation from tariffs, so inflation being one. And then the second is a collapse in AI enthusiasm. So as long as neither materializes, stocks may stay on their upward trend. But Lisa Shallett at Morgan Stanley warns that this rally is pretty narrow. Mega caps have driven over half of the market's returns in the last 5 years. So if AI returns begin to disappoint, the whole index is exposed. Then Stifel's Barry Bannister even sees the S&P 500 falling back to 5,500, arguing that AI spending won't necessarily save the economy if growth weakens. And when you think about that a little bit deeper, it doesn't. Because if companies are trying to become more efficient and save more money, that is less need for workers and, in a way, kind of scary for the workforce as an entire. So we were just talking about how this unemployment rate's been ranging from 4 to 4.2%. That's with companies not hiring right now. Yeah, they're not really laying off. We fell in this range, but if companies aren't hiring and less need to hire in the future, and companies just relying more on AI with less employees utilizing this AI, that's where it gets a little bit scary. Then there's this warning from Sam Altman. So even OpenAI CEO Sam Altman admits that AI might be in trouble. But he also says it's the most important innovation in decades. We can't get behind on it. But that captures the duality, hype versus genuine transformation. So that leads us to what's to come on Friday. Jackson Hole. That's the big catalyst of the week, probably of the entire month. So Fed Chair Jerome Powell speaks on Friday. So back in 2022, he used this stage to really slam the brakes on the bear market rally with a tough inflation message. Historically, Jackson Hole weeks have been slightly positive for stocks if you look back in history, but with inflation sticky around 2.6% on PCE, or personal consumption expenditures, and this is the Fed's preferred gauge of inflation as far as measuring it, and tariffs lifting costs, Powell might not give the markets the dovish cut that they want. He might talk a little dirty to the markets. So the Fed could cut in September, but still sound hawkish about it, reminding investors that rates will stay higher for longer. Y'all are lucky we're even cutting. That dang meddling kid over there doing all the Trump tariffs, that's a recipe for volatility. Now, finally, tariffs. So Trump just expanded 50% duties or tariffs on steel and aluminum to hundreds of finished goods, everything from HVAC units to transformers. That's $328 billion in products now being taxed. And some call this a win for the US aluminum producers, while others warn that it could slow AI infrastructure way behind by raising equipment costs and building costs. But either way, tariffs are inflationary and could tie the Fed's hands. So, y'all, where does this necessarily leave us? Because stocks are strong, but they're narrow. Inflation risks are real, especially with these tariffs that are becoming to materialize in the data. AI is fueling excitement, but maybe too much of an extent. The Fed is walking a tightrope with Jackson Hole as the next big moment, and it'll probably be an opportunity for them to calm everybody down regarding these Fed rate cuts. And this is a market not priced for perfection, but for balance. And balance can tip very, very quickly. We'll keep on watching what happens, y'all. I'll see y'all, and especially on Friday.